The next global financial crisis may be just weeks away. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the Fed's main bailout tool for the international banking system. And make sure you stay to the end of this video because we're going to compare how this bailout tool is being used today to how it was used during the first GFC, 2008, when Lehman Brothers and Bear Stearns was going bust. We're going to look for the canary in the coal mine, and I can promise you this intel that I'm going to reveal in step number 3 is going to shock you. So let's get into the Fed's preferred bailout tool for the international banksters themselves. This would be swap lines. So how do swap lines actually work? It's pretty simple, actually. We've got the Fed. In this case, we've got the Swiss National Bank. They have been in the news a lot lately, especially for Credit Suisse. More on that in just a moment. But we've got the balance sheets here. Assets on the left, liabilities on the right. So basically, the Swiss National Bank says, hey, we need some dollars, so we'll go ahead and swap the dollars for some Swiss francs. So those Swiss francs go onto the Fed's balance sheet. They're an asset. Those dollars go onto the Swiss National Bank's balance sheet as an asset. And then, of course, those francs that go over to the Fed, they're a liability on the Swiss National Bank's balance sheet. And likewise, those dollars are a liability on the Fed's. So why are they a liability on each other's balance sheet? Pretty simple. They have an account at each other's bank. Just like you have an account with Wells Fargo, the Fed has an account with Swiss National Bank, and vice versa. So what happens prior to the Swiss National Bank actually asking for the dollars in the first place is they hold weekly auctions every single Wednesday. And usually there are no bidders for dollars that the Swiss National Bank could access via the Fed. But in times of trouble, when the banking system is starting to crack, like at the beginning of a global financial crisis, you see the bidders start coming in to the Swiss National Bank because they need those dollars desperately or they're going to go bust. So the sequence of events works like this. The Swiss National Bank holds an auction on a Wednesday, and let's say that in this case, they get 3 banks that are bidding for dollars. And those banks request $1 billion from the central bank. So they'll go to the Fed and say, hey, Fed, we need $1 billion. The Fed will give it to them. And the Swiss bank will give the Fed an equal amount of francs at a pre-negotiated exchange rate. And then at the end of the 2 weeks or month or whatever the term is, they'll go ahead and swap back. So the Swiss National Bank will give the Fed the dollars back. Editor, why don't you go ahead and help me out with this one? So it's just the reverse. Instead of the dollars going from the Fed to the SNB, they go from the SNB back over to the Fed, and the francs go from the Fed to the SNB. Now, when they pay them back after the end of the term, they add a bit of interest. So it's not exactly free money. And likewise, for the banks that bid on the dollars from the central bank in the first place, they have to pay it back at a specific term with interest. Now, I know a lot of you are probably scratching your head right now and you're looking at this and saying, okay, George, well, why doesn't the Fed just go directly to the international banks? Well, because that would be against the Federal Reserve Act. That's against the law. And even though they're doing the exact same thing, if they put in a middleman, then somehow it makes it okay. Just like when the Fed was buying corporate bonds during the cerveza sickness. If we could just put in a special purpose vehicle, well, now all of a sudden it's okay. It's no longer against the law. When in reality, the net result is the exact same. So when these banks are going to the Swiss bank to get the dollars they need, they're basically going directly to the Fed. And if they need dollars, there's a big reason why, and it's not good. So I think you can safely say that the Fed is bailing out these international banks directly via the SNB, the Swiss National Bank. Step number 2, the canary in the coal mine. So have the international banks been using this stealth bailout from the Fed? Or maybe a better question would be, to what degree have they been using it? And what does this mean for the probabilities of us going into a global financial crisis within the next few weeks? So like I said, these auctions happen once a week on Wednesdays, and usually there's no one that shows up. The banks don't need the dollars because they can produce the dollars themselves. More on that in just a moment. But a couple weeks ago, we started to see the banks show up and basically beg the Swiss National Bank for these dollars. Now, for those of you who are really paying attention, you're probably saying to yourself, well, George, this transaction between the banks and the central bank, it seems a lot like a repo transaction. And you would be right. That's basically what's going on here. Instead of using another bank as a counterparty in the repo transaction, they're just going directly to the Swiss National Bank, similar to what the Fed has set up with reverse repo and the standing repo facility. They're basically trying to backstop the repo market so we don't get a spike like we saw in September of 2019. So let's get right back into the data. Like I said, 2 weeks ago, banks started showing up needing dollars desperately. Initially, there were 9 counterparties that requested around $3 billion. But what happened last week? Did it go up or did it go down? In other words, did it get better or did it get worse? It got much, much worse. Last Wednesday, 15 counterparties showed up and requested $6 billion. Now, you ask, George, which banks are going to the SNB needing these dollars? Therefore, which banks are most likely to go bust? Well, we don't know because these auctions are anonymous. Well, okay, can we safely say that it's a Swiss bank like Credit Suisse or maybe UBS? Because they're the ones that would most likely be involved in the Swiss repo market. You may be onto something, but I think the problem is much, much worse. Meaning, this is not just an issue with the Swiss banks. It could be an issue with the entire global monetary system. For more on that, editor, let's cut right to a clip from my good buddy and Eurodollar expert, Jeff Snyder.
So something is going on in Switzerland. It could be Credit Suisse, but it's also not just Credit Suisse. And it could be that the market is looking at Credit Suisse and saying, we don't like you and we don't like all those around you. But I don't think that's the case. I think it's much more significant than that, particularly because it's Switzerland. Switzerland is, as I said, a money center hub for the global monetary financial system anyway, especially when it comes to US dollars. So it is more likely, in my opinion, that there are banks from all around the world who have subsidiaries operating in this jurisdiction who are then bidding for US dollars from the Swiss National Bank, purposely using Switzerland to mask their location. Because these are all anonymous, we don't really know what banks are bidding for auctions. Furthermore, if you can do it through Switzerland rather than your home country, that helps mask the problem too. What if these are UK banks that are bidding for funds through Switzerland and then of course transferring those dollars back locally to the UK or anywhere else around the world? That's kind of how this works, this dollar system. You don't have to be a Swiss bank to access the Swiss National Bank. It can be, what I mean by Swiss bank, you don't have to be a specifically Swiss bank. So what's going on is much wider than just Switzerland. It's the question isn't what's wrong with Switzerland, it's what's wrong with the entire dollar system.
So like Jeff said, although we're just focusing on the Swiss repo transactions with their central bank, it could be global banks that are really having the issue. So not just Credit Suisse or UBS, but maybe also Barclays, Deutsche Bank, and HSBC. And I want to give a huge hat tip to my good buddy Jeff Snyder and his podcast, Euro Dollar University. This is where I first found out about these repo transactions, or the stealth bailout from the Fed to these international banks. But the next question becomes, okay, George, I see what you're saying here, but maybe they just need some dollars, and maybe it's a little more efficient to go to the Swiss National Bank. What's the big deal? This is much ado about nothing. Well, let's think this through. Usually, when the banks are healthy and the global economy is running on all 8 cylinders, the banks can create as many dollars as they want. Now, this may sound shocking, or this may come as a surprise to some of you who are new to this channel. But for those of you who have been watching my videos, you realize the Eurodollar system, the global monetary system, is pretty much cashless and reserveless. They don't need bank reserves from the Fed denominated in dollars to create dollar-denominated loans. And if you go back to step number 1 and you see how these dollars just went right onto the balance sheet of the Swiss National Bank, you have to realize there's no reason the commercial banks can't do the same thing. Well, there is one reason, and that's counterparty risk. And that's the point, pretty much, of this whole video. But let's go over to some sample balance sheets so you guys can get your head around this. We've got Bank A, Bank B, assets on the left, liabilities on the right. So basically, let's assume, just like our first example here in step 1 with the central banks, that Bank A has, let's just say, a checking account. Bank B has a checking account at Bank A. And these checking accounts are liabilities of the specific bank. So to be crystal clear, this checking account that Bank B has, that's an asset on its balance sheet, this checking account is with Bank A, therefore it's a liability. So however much or however many dollars Bank B has in their checking account with Bank A, that many dollars would be a liability of Bank A, and vice versa. So Bank A goes to Bank B and says, hey, listen, we both need dollars, so I'll just go ahead and credit your account with $1 billion, and you can go ahead and credit my account with $1 billion. So that would be an additional liability of $1 billion for both of these banks. But remember, they are increasing their own checking account by $1 billion as well. So you have an additional $1 billion in your checking account, which would be an asset to offset the $1 billion liability that you just added to your balance sheet by adding the dollars to the other bank's checking account to begin with. So I know that gets a little confusing, but basically the easiest way to think about it is you got 2 banks, they've got checking accounts with one another. One bank deposits money or dollars into the other bank's checking account, and the other bank does the same thing for the first bank, and voila, you have created dollars in a cashless, bank reserveless system without any help of the central bank. So, of course, we go back to the whiteboard and you say, well, George, why aren't they doing that? Why are they going to the Swiss National Bank and basically getting a bailout from the Fed? Because the only reason that these 2 banks wouldn't create dollars on their own is if they didn't have the confidence that the counterparty was stable. if they didn't have the confidence that the counterparty was going to be in business in the next week, 2 weeks, or month. So this is why when you see these repo transactions occurring and going from 0 to $6 billion and from 0 counterparties to 15 counterparties that could be spread out all across the globe, this tells us, or this is the canary in the coal mine, which could turn out to be the next global financial crisis. Step number 3. Now it's time to reveal some shocking data, which will help you answer the question, should I be concerned? Well, in fact, I can answer that question for you right now. The answer is yes. You should definitely be concerned. But let's get into the data to determine how concerned you should actually be. So let's think this through before we head to the internet and get into the intel from the Swiss bank. If we're to assume that as these repo transactions increase, it is the canary in the coal mine. This is the banking system basically telling us that there's too much counterparty risk for it to create the dollars it needs to function. Therefore, it's going to the central banks basically for a bailout via the Swiss repo market. If we're to assume this is what's happening, then we would also need to see the same thing happening in other banking crises, such as the cerveza sickness. So we need to go back to the Swiss bank's records and say, hey, what were these repo transactions doing during the cerveza sickness? And more importantly, what were they doing during the GFC? Because let's just assume for a moment that there was nothing going on during the GFC, that the auctions were getting zero response. Well, then what we're seeing lately would be just an anomaly, and this would be a nothing burger. But I think you can tell where I'm going with this. Is it wasn't a nothing burger. In fact, these swap lines were utilized to a significant degree during the cerveza sickness and especially during the GFC, which would lead one to believe that what we're seeing now is just the tip of the iceberg. When the auctions go from 3 billion to 6 billion, what will they be next week and beyond? So let's go right to the internet, like we said, and see what the specific numbers are telling us from the Swiss National Bank. Okay, here we are, and we can start off by seeing the auction date, the term in days. So earlier I was saying 2 weeks or a month. Looks like they're mostly 7-day, 1-week repos. The payment, redemption, auction type, the interest rate, which I think is interesting. And then most importantly, we can see the number of counterparties and the total sum of bids and then the total allotment. Like we said, it's gone from pretty much 0.00000 to 9 and then to 15. Although we did see a little bit here, although 20 million, I don't know that's a significant number at all. Pretty much a rounding error for most of these banks. But it did give us a preview that the repo transaction would increase to a significant degree in weeks to come. So just because you see a 50 million here, this is an anomaly when you look at the fact that usually there is no counterparties that show up for these auctions. In other words, no global banking counterparties need the dollars because there's sufficient confidence in the system for the banking system itself to create the dollars they need to function. So remember, if our hypothesis is true, that this is a canary in the coal mine, and it's an indication that there are some severe cracks in the banking system that could lead to the next global financial crisis, you would see the same type of transactions occurring during the cerveza sickness when these banks obviously were under a lot of strain. So we pull up the transactions, again, from the Swiss National Bank going back to March of 2020. And what do we see? It goes from 315 to 2.3 billion. Now, one thing I'd like to point out, it didn't get up, at least in this time frame, it didn't get up to $6 billion. But what we could see is that it was consistent. Every single week, there were banks that were going to the Swiss National Bank saying, hey, we need dollars because we are in big, big trouble. And lastly, let's go to the GFC. In fact, let's go before the GFC to December of 2007. And you can see these swap lines were utilized to a significant degree. The first transaction we've got, $17 billion. And again, I want to point out, this is before Lehman Brothers. This is before Bear Stearns. This is still in 2007. So if you were paying attention to these data back prior to the GFC, you would have known. You would have seen the canary in the coal mine, just like I'm trying to point out the canary in the coal mine to you today. Now, again, I'm not saying we're going into the next global financial crisis. There are no certainties, only probabilities. I'm bringing this to your attention so you can see what has happened in the past and realize that what we're seeing today is an indication that the risks in the global banking system are increasing exponentially. So you can see that pretty much every single week, starting in December of 2007, going throughout the entire year of 2008, these dollar swap lines were utilized to a significant degree. Just scanning this spreadsheet quickly, we start off with 17 billion, like I said, but look at this. In September of 2008, $23 billion. So pretty much every single week until most likely quantitative easing, these global banks were utilizing these swap lines to access the dollars they needed so they wouldn't go bust. I want to be very clear. This is the Fed directly bailing out, maybe you could say indirectly because you got a middleman in there, which is the Swiss National Bank. But I would say this is the Fed directly bailing out the global financial system back in 2008. And I think we could see the same thing happen in the very near future. So what we'll have to look out for in weeks to come is the consistency of these weekly auctions and the dollar amount. So I just threw up this little chart here to help you get your head around it. On the left, we've got 0 billion up to 20 billion. And as the dollar amount goes up, assuming the weekly auctions are consistent, one after the other, after the other, after the other, as this continues, the risks and the probabilities of us going into a global financial crisis 2.0 definitely accelerate. So this is something that is paramount to pay attention to in weeks to come. And I can promise you that we will be doing that right here on the George Gammon channel. For more content that'll help you build wealth and thrive in a world of out-of-control banks and big governments, check out this playlist right here. And I will see you on the next video.